So the last time we introduced ourselves to a few key concepts within fixed income. So especially things like and basic properties of bonds and maybe what are coupons, what are floating rates, etc. Uh, yeah. So now could be a good idea to talk about spot rates and implied forward rates. So spot rates are also what we call as zero rates. So have you? So has interest rate swaps been covered in your previous subject?
Yes, sir,
So
we've
this will be
covered
for
it,
financial
but
economics,
again,
I believe.
very briefly.
Okay, okay. So at that time, was the idea of zero rates introduced to you guys?
No, sir, I don't recall that part.
So give. Okay, okay. All right. So because that is like something which we use in swaps as well. Rather, I mean any floating rate product, I would say. Okay. So we'll start from the basic. I mean, what is a zero rate, and then exactly how do you have a bootstrapping engine, etc. So I think can I do the working here? All right. I think I'll use the white space available, and if required, we'll switch to whiteboard. Okay. So when I say a spot rate or a zero rate, it is a rate on a equivalent zero coupon bond for a certain maturity. So let's say I draw a snapshot of a yield curve, tenor and yields. Let's say 1 month, 6 months, 1 year, 2 years, 5 years. Let's say this is my snapshot, and I just put in some numbers. 2%, 0.5%. All hypothetical values, but just for analysis, that is fine. So let's say this is my input curve. So this is something which I've fetched from the market. So imagine that this is my swaps curve, which I've simply fetched either from Bloomberg or from Reuters. And now my idea is to build a equivalent zero or spot rates, or I want to derive these spot rates. We also call them as zeros many a times. So let's say I want these spot rates to be derived. That is, I want to know what is the rate on a zero coupon bond for a maturity of 1 month, or maybe what is the rate on a zero coupon bond for a maturity of 1 year, and so on. So the idea is once I have access to spot rates, I can use them for a variety of purposes. So I can use it primarily for discounting because I know for a zero coupon bond, it's like one single shot payment which happens. So any cash flow, so that way I can say my spot rate for 1 month is 2%. So any cash flow which is coming in at the 1 month time point, I can use 2% as the discount factor for discounting that cash flow today. Why I say today? Because every day I'll have a new set of rates. The methodology will not change much, but new rates will come in and your calculator will get updated with new values. But the idea is once I have this zero rate for, let's say, 1 month, then I can discount any cash flow which is appearing at the 1 month time point. So that becomes easy from my product pricing perspective. So how do you derive spot rates? So I'll draw a small division here. So if you see the spot rate, the yield curve has been split into two parts. Above the curve, we have tenors up till 1 year, and below we have anything which is beyond 1 year. Now, up till 1 year, I can directly equate the yields as spot rates. That is, I can safely take my, because these are all money market products, right? So, I mean, I can simply take the money market products, or these are also what you call as deposit rates. So, either depot rates or money market rates. So, you simply take the yields and you equate them as spot rates. Nothing to be done. But beyond 1 year, that is not the case. So now, if someone says that you can equate this thing as 3.5 directly, this would be incorrect. This cannot happen because beyond 1 year, your effects of compounding start coming in. So you have to factor that into your calculations. So beyond 1 year, simply equating yields equal to spot rates will be incorrect. So this is where I need to use the idea of bootstrapping. So we'll see what bootstrapping is. We'll also see an algorithm around it. Maybe we'll do some simple hands-on in the next class also. So for that, I require bootstrapping. So when I have a bootstrapping engine, it will help me derive what the spot rates are for any tenor in the future. So not just 2 years, 5 years, but if I have the required yield curve, I can do it up till any tenor. Let's say 30 years is my maximum tenor. So as long as I have the market data, I can do the calculation and arrive at spot rates. And this is something which we will derive through bootstrapping. But the basic idea is you can imagine spot rates are rates on zero coupon bonds of a certain maturity. So you can have a zero coupon bond with 1 month maturity, 1 year maturity, 5 year maturity, and so on. So for each of these bonds, whatever spot rates you have, those rates are that one single shot rate, which will be corresponding for that particular time point. And because of that, you can use these rates directly for discount purposes. So as I mentioned earlier, if I have a cash flow which is coming in at 2 years, let's say coming in at 1 year. So let's say this is my 1 year cash flow. If I have to PV this, then I simply do this into e raised to minus RT, which is e raised to minus R into T, which is 1 year. And this will help me calculate the PV of my cash flow. So does the idea look okay?
Sir, how are foreign like spot rates and forward forex rates different from spot bond and forward bond rates?
So they are a different asset class that way. So the thing which you do via interest rate, something like F equal to S into 1 plus RDC upon RFC raised to T. So this is what you have for the FX or maybe something which links FX and interest rates. Now the thing is that they are related asset classes, but I would say the idea behind them is different. One is for computing what the expected FX rate is, whereas bootstrapping. So although the nomenclature may be similar, so spot rates and forward rates. So many a times when you say spot rates, we generally talk about maybe spot rate for equity or maybe spot rate for FX, etc. But these spot rates are slightly different. So don't be confused by the nomenclature. So these spot rates are specific to something which we are doing for bonds. So if you feel spot rates to be confusing, you can also call them as zero rates. To maybe this terminology could be something which would avoid confusion, at least in the initial stages when you're reading it for the first time. So you can imagine that this is specific to this asset class, interest rates. And what calculations we do here can come handy in our calculation for IRP. So you can imagine RDC and RFC are equivalent zero rates as well. So that's applicable also. But also what I would like to say is don't be confused by the nomenclature. Consider that we are focusing only on the interest rate market right now. We are not worrying about FX. So that way, maybe we'll call spot rates as zero rates and we'll keep the implied forward rates as it is.
And sir, where are they used? Because it's written pricing bond using spot rate. So that means spot rate is not itself the price of the bond. So
No, no. So we'll come to that. So maybe once we have an idea of how exactly. So maybe if anyone has any questions on spot rates, we'll resolve that first, and then we'll come to the spot rate. How to use it for bonds.
okay, sir.
So anyone has any questions? Okay. So coming to our next point on pricing of bonds using spot rates or zero rates. Now, up till now, whatever bonds we have taken are vanilla bonds or very, very standardized bonds. So the price versus yield, a relationship which we studied the last time. So we had something like a bond price equal to C upon the respective yields. Let's say I have a 2 year bond and with annual coupon, it could look something like this. So this could be like a tenor of 2 years and a coupon frequency of annual. So I have just two cash flows. Now, for most standardized bonds, and I would say the standardized bonds occupy majority portion of the market. So whenever I have a standardized bonds, I can safely use the concept of YTM or yield to maturity in the calculation. So the Y which I have in the denominator is the same yield oblique YTM as we call it. Now for plain vanilla bonds, that's an acceptable measure. Now why I say that? Because for plain vanilla bonds, you have certainty about a couple of things. So firstly, you have certainty as to what is the total tenor. Also, at the same time, you know the respective time points at which you're going to receive cash flows. That is, you know for sure that your cash flow is going to be received at 1 year and 2 year respectively for this bond. There is no other time in between. So that way, we are following a certain standardized frequency. So that way, we have a certain period which is defined, and that is the periodicity which will be followed by my coupons. But there may be certain structured bonds. That is, let's say I have a bond with, so let's say I have a 2 year bond. However, now my coupons are slightly erratic. Now they are not really following a certain frequency. So let's say I have 4 or 5 points at which I'll be receiving some coupon. Now you can structure a bond in the way you like. So maybe my first coupon is received in 1 month. Let's say the second coupon is received in 7 months. Let's say the third coupon is received in 18 months. Let's say my final and fourth coupon is received at the 24-month time. Now, here if you see, I have an erratic schedule which is being followed. C1, C2, C3, C4. They are appearing at different time points. Now, there is no set frequency for this. Now, in this case, I cannot use the idea of YTM because YTM requires periodicity, and that periodicity needs to be standardized. Now, here there is no standardization, right? I have structured the bond the way I like. Now, if I want to calculate the PV for these cash flows, if I want to know what is the present value of all of these cash flows because I want to know what is the PV of the bond, I'll have to use zero rates. That is, I'll have to use a zero rate for 1 month, a zero rate for 7 months, zero rate for 18 months, and a zero rate for 24 months. And once I have these zero rates, I can use them as discount factors for discounting cash flows C1 through to C4. And that will help me calculate the bond price for this non-standardized bond. So when I say pricing of a bond, you can think of this as non-standard bonds. So does this sound okay?
So theoretically we understand, but the practicalities of it, like how to derive the discounting factor.
That we'll see. Yes. So that will come via bootstrapping. So something which we have given in the next 2 points. So that is something which we'll study anyway.
Uh,
So the methodology we'll see. But other than the methodology, any doubts up till now?
so just one more thing. In this example, you have created the coupon payments as per your discretion. But in practicality, is it an ad hoc or is it predetermined coupon rate system?
So the time points of the coupons will be fixed. So that way, even if it's a structured bond, at the time of signing the contract, you will generally decide on what the time points are at which you'll receive coupon. So there is no surprise element as such.
Okay, sir. Thank you.
Now, to understand bootstrapping, now we know that up till 1 year, I don't need to worry about things. But beyond 1 year, I need some kind of a approach or methodology to arrive at what these respective spot rates are. So we'll try to see that now. So I have a small working in Excel. Let me open that. Share Excel. Maybe I'll just zoom in a bit. Okay. So a simple example as to how you derive spot rates. Maybe later on we can do some simple hands-on modeling as well using Excel VBA. So maybe that is something which we can try on Saturday or maybe in the next week. So let's say I have a certain bond with a face value of 100. Now imagine I'm taking a US Treasury bond. So by default, the US Treasury bond follows a semi-annual frequency. Something similar we have in India as well. The most popular frequency is semi-annual. Now I have four bonds which are given to me. So a bond which matures in 6 months, 1 year, 1.5 year, and 2 years. So these are my time to maturities for the respective bonds. Then I have the bond prices. So that is, I have these par yields. So I can also write this as coupon slash YTM. So these are my par yields. So par yields basically imply that these are the yields at which my bond will trade at par, or it will trade at 100. So these are something which will act as an input to my model. Now this is just time to maturity. This is easy. But other two things, these are something which I have as inputs. And my idea is to calculate this cell. So something which maybe I can highlight in blue or something. So these are the things which I'm trying to calculate, the cells in blue. So, and this is what I call as my spot rates. That is, my idea is if I have inputs for these respective tenors, I should be able to have, so these tenors and have these rates which are given to me. So based on this, I would like to derive what the equivalent spot rates are. So let's say that's what we are trying to accomplish now. So let's start the process, how that can be accomplished. Now we know that up till 1 year, there is no bootstrapping, because up to 1 year, I don't have to worry about the effects or impact of compounding, because these are money market or deposit rates. So that's why you see that for the first two tenors, 6 months and 1 year, I have my spot rates which are equivalent to yields. So my yields are 3% and 4%. So respectively, even my spot rates are 3% and 4% for 6 months and 1 year. So nothing to be done for the first two cells. So I can just maybe remove the color here. But the actual computation will begin from this point. So anything beyond 1 year. Now, this 5.03 is calculated through a certain approach. So I'll tell you what that approach is. So maybe we can see the workings here, and then I can show you a simple formula on the whiteboard, because the formula here will look very, very messy because it's an Excel formula. But if I can simplify it and show it to you, I can do it on the whiteboard. But anyways, till then, we'll generally walk through what this cash flow is. Now, just focus on this bond with a 1.5 year tenor and a coupon of 5%, which gets paid out semi-annually. That is, I have two coupons every year. Now, in order to arrive at this 5.03, I've done the small calculation here. So we have three time points which I'm interested in: 6 months, 1 year, and 1.5 year. So these are my times. And I have my coupon of 2.5, because I have a total coupon of 5%, which gets paid out semi-annually. So 5% by 2, so simply 2.5, and I have face value of 100, so 2.5 units. So my first cash flow is 2.5, 2.5, and the final cash flow will be 102.5, which is 100 plus the coupon payment. Now, these you can imagine are my non-discounted coupon values, because I haven't really applied any discount factor up till now. Now, my idea is to calculate what the spot rate is for 1.5. That is, imagine I'm trying to calculate Z 1.5, that Z is the unknown spot rate for the 1.5 year tenor. So I have the first two spot rates which are directly available for me. So 3% and 4% is something which I can directly use, because these are these same spot rates which I already have in my possession. So I'll use 3% and 4%. I'll simply equate them here because I want to use them in the formula. How that is used, I'll show you on the whiteboard. And based on that, I try and estimate what the Z 1.5 rate is. So maybe let me switch to the whiteboard for a moment so that I can show you what that equation is. Okay. So let's say I am interested in calculating the zero rate at 1.5 year tenor. So I have a bond price. So I have a bond trading at par. So the par yields are available. I have this coupon of 2.5. So I will not adjust any frequencies here. I'll just keep it plain and simple. Ideally, I need to adjust 3% for semi-annual, etc. And this periodicity also needs to be adjusted. But I'll keep the equation simple here. Anyways, I'll share the Excel with you guys so you'll have the exact workings with you. How do you adjust for compounding, etc. Here, if I do the same compounding effects, the equation will be as complicated as it looks in Excel. So let's keep it simple here, but the adjustments have been done in Excel. So let me write this first, and then we'll see what is happening. So this is 6 months, this is 1 year, this is 1.5 years. Now, I have basically solved this equation in Excel. Only thing is, after adjusting for frequencies, that becomes slightly complex looking formula, but it isn't very complex. It's essentially the same thing. So my left hand side, I know that a bond price which is trading at 100 or a bond which is trading at par. Then I know my coupons, right? It's 5% coupon. So semi-annually, it's 2.5 each, and final coupon plus the face value makes it 102.5. Then I have the respective spot rates for the first two tenors which I already have. That is 3% and 4% is something which I directly infer from the available yield curve. Now, my only point is I want to estimate what is Z 1.5. So I have one equation and I have one unknown. So I simply move everything on the left hand side and I solve for Z 1.5, and this gives me what is the spot rate for Z 1.5 or 1.5 year, and I think that comes out to be 5.03 or something on my Excel. So does this equation look okay?
Yes, sir.
Okay, so if you have to solve this equation, how would you want to solve it? Not manually, but through some tool. So any libraries, etc., which you can think of. Because right now it's just a cubic, but tomorrow, let's say I have a 10-year bond, then I'll have 1 plus Z10 raised to 10 or 20. So that way my powers of this denominator can keep on changing depending on the time to maturity for the bond. So can you think of a certain approach to solve this? So if you have to tell a computer to solve this for you, how would you want to approach it? Anyone? Because finally, I mean, you can't really do these things manually all the time. You'll have to have some algorithm to do it for you. So what could be a way to do that? So maybe either Excel or even through any scripting tools which you want. So I don't need the exact code, but maybe at least an approach which you can think of. So I'll give you a hint. This will be very similar to a root finding exercise. Now this is just root finding, isn't it? Because I have something raised to higher order powers and I'm trying to solve for that. So it's very, very similar to what you can do for root finding. So anything like this, which you might have covered in your business analytics class. Okay. So, I mean, you can do it through a simple VBA as well, through a simple loop as well. This can be accomplished because this is not a very difficult looking equation. So either through a VBA, through looping, or maybe you can use a Python as well. Any tool, but you should figure out some way to do that. So let's see, if time permits, we can do a small modeling activity ourselves, so we know how to solve such equations. But this is just similar to root finding. So you might have studied root finding in the past. So Newton-Raphson bisection, Runge-Kutta methods, etc. So something similar can be applied here as well. Of course, now you don't have to dive deep into those methodologies anymore because you have ready libraries to call those functions and use them directly. So any kind of other complex root finding activities, you can easily use advanced utilities. Now, these kind of equations, they are pretty straightforward. Now, this is something which you can do in Excel as well. So when I say Excel, mainly VBA, but that is doable. So let's see, if time permits, we can try to do something ourselves also. So this is the approach for Z 1.5. Now let's say I want to repeat the same thing for Z2. So I'll just look up what the coupon is and I'll write the equation and then we'll go back to Excel. So I don't have to keep switching back and forth. So coupon is 5.5. So 5.5 basically implies 2.75 coupon. Okay. So I have the next bond with a 2-year maturity, which has a coupon of 5.5%. So accordingly, I'll write the equation now. Only thing is there will be one additional term which we have. So now 2.5 will become 2.75. So I'll be using this 5.03 which I've calculated. Again, I'm not adjusting it for compounding. I'm keeping it plain and simple.
Sir, can you please explain again why it would be 2.75?
Yes, yes. So actually, this is my market information. So I have my bond with a coupon of 5.5%, which is given to me. So I'm simply taking 5.5 and I'm dividing it by 2. So that's how I get to 2.75.
Okay, sir.
So when I go to Excel, you'd see the coupon. So that way, if you see, the equation is very, very similar looking to above. We have a bond which we have the par value for the bond, which is 100. Then we have the coupons of 2.75 each and the final cash flow of 102.75. We have the first three zero rates, 3%, 4%, and 5.03, which you have just calculated above. And we have one unknown, Z2, which we are trying to imply. So that way, again, we have one equation and one unknown, which we are trying to solve. And that way, I get Z2. So I think Z2 was coming out to be something like 5.55 as per my calculation. So we'll see that in a moment. But this is how I can do it for 2 years. Likewise, I can do it for any time point in the future. So does the approach look fine?
So the denominators will be raised to the power
Yes,
like
yes. So they will get
one.
adjusted.
So it will be one or like it's written 1, 2, 3. So it will be 1.5, 1.5.
So you can keep it period. So you can maintain a periodicity as well. Now here, as I mentioned, I have not adjusted anything. I have not adjusted it for compounding. I have not adjusted it for powers, etc. But in the Excel, that has been done. So don't worry about the powers. Just worry about the logic right now.
Okay, sir.
Because right now it's a semi-annual bond. Tomorrow, if you have a quarterly bond, that will change. So that's why I've kept this representation generic. In Excel, I've made that semi-annual adjustment.
Okay, sir.
So that way, if you see that this is a recursive activity, so you may be given the entire yield curve. So let's say you could have something from let's say 1 month up till 10 years, and you may be asked to derive a spot rate for them. So any one of you joining risk management or anything or anyone joining as a part of fixed income desk? Okay, because if you're a part of RM or even front office trading, especially around fixed income.
Sir, a few of us from our batch will be joining risk management,
Okay,
but I don't think even they will know what kind of products they'll be handling.
okay, okay. Uh, so generally, which firms are hiring for risk? I mean, are it consulting firms or are they banks?
So JPMC I think was hiring for risk.
Okay, and so did they specify anything like maybe risk monitoring or is it model development, model validation? Did they specify anything?
Sir, I guess the candidates will know the best.
Okay, okay, all right, all right. But good. I mean, JPM is a large bank, so I'm sure you'll find these applications somewhere there. So not just JPM, but any other bank or any other consulting firm as well, because finally even consultancies work with banks and financial institutions. So they require these kind of things. So this is how you can actually build a spot rates curve or a bootstrap curve, and that way, given a tenor versus yield chart, you can build your own zero rates curve, something which you can readily consume downstream as well. So going back to Excel. So right now I've written this plain logic. I haven't really done any coding here, but it can be done. So let me just hide this column. Reduce the width, even this thing can go. Now I want to estimate this question mark, which is the 2 year spot rate. So equation very similar to what we have done on the whiteboard. So if I just scroll down a bit and I scroll to the right. So again, like my previous exercise, I plot my time tenors, which is 6 months up till 1 year. I plot my coupon payments, which is 2.75, which is simply 5.5 divided by 2 into 100, so 2.75 each. Then I plot my spot rates, that is 3%, 4%, and 5.03, which I just calculated some time back. And based on that, I imply this rate of 5.55. So, and although the equation may look slightly difficult, and it's just an interpretation of what we have done in Excel. Oh, sorry, what we have done on the whiteboard. So accordingly, based on the periodicity, your equation will change. So right now it's semi-annual. For compound, for quarterly, you may have to divide it by 4 and so on. But the approach will not change much. Approach is exactly the same. So that way, now this I have done just for demonstration. So that's why I've done it for 2 tenors. Now tomorrow, if you ask me that, I'll give you the data and tell me what is the spot rate for 5 years. Now I won't be able to do it manually. I will be, but it will take a lot of time because then I have to create so many sections, right from 2 years up to 5 years, which is very, very inefficient. In a real-time project environment, that is something which won't work. So you may have to have some technique to build a spot rates curve. So maybe you can have a model which can fetch this much information, which is my input, and it will give me a spot rate curve directly. So that is something which can be done. So possibly in our next class or maybe on Monday, we can try to do some bootstrapping activity. So that way we can take the same yield curve which we have, because that way we'll have something to check our calculations also. So that is something which we'll do. So as I mentioned in the last week, I request you guys to brush up VBA because we'll be using VBA for this, and we'll try to build our model. So at least the basics of VBA is something which I expect you guys to brush up, so that we don't have to start from scratch and we can start from a certain level and we don't waste time. Yeah. So later on I'll share this Excel with you, and it's a simple working. It's just for 2 tenors. Now tomorrow, if someone gives you 2.5 tenor, then you have to introduce a third section for that. But for demonstration purpose, this is good enough, but this can definitely be automated. Now, this was spot rates. And as I mentioned, one of the main applications of spot rates is it can help you arrive at what are your discount factors for various time points. Now we'll talk a bit about forward rates. So there is a relation between this and forward rates as well. So again, let me switch to the whiteboard and stay on the whiteboard for some time now. So I can read the point from the PPT and we can discuss. So there's an idea called as forward rates. So can you think of what could be a forward rate? So what could be the idea of a forward rate? Anyone?
So quoting future rate in the present, like basically anticipating what would be the scenario in the future and presenting it currently.
Okay, so can I say something like this? So let's say I'm looking at a 2-year tenor. Actually, I split it up into 1 year each. And here I have, let's say, the rates. So I have the rate for 1 year. I have the rate for 2 years. And can I say that this is something like my forward rate? Would that be correct?
So in the context of standing on year one,
Standing here.
yes, sir, it would be a forward rate.
Okay. So does everyone agree that F11 will be a forward rate? That is, can I say that standing on this right arrow, on this red color arrow, that this is the 1 year rate 1 year from today? Would that be a correct way of putting it? So can I say this is my best estimation of what the forward rate is going to be in 1 year's time for a tenor of 1 year? So any questions on this? Okay.
So the best estimation will be when you will be as close to the time point.
Of course, I mean, as the time passes and we are actually standing on the 1 year point, we'll have a direct comparison anyway. So today I may want to enter into a contract whereby I may want to, let's say, freeze on this rate. And then maybe when I'm on 1 year time point, I'll see whether my estimate is correct enough to the actual rates. So yes, that can be an application. So can you think of a product which might have been discussed in your derivatives class which uses this idea?
Currency.
No. So can you think from an interest rates perspective?
So your interest rate swaps are based on forward rates only, right?
Yes, something simpler. So swaps can be a step ahead. Maybe if you could take a step back. So something simpler than a swap. So imagine, so I'll give you a hint. There's
So could
just
you
one.
repeat your question? I'm so sorry.
Yes, yes. So can you, so as a part of your derivatives class, you might have studied one product which is based on this idea of forward rate. So can you think of that product? So Ali said swaps. So that is definitely an application, but maybe something simpler than a swap.
So I guess forwards and futures.
So in forwards, can you think of something specific? So you're right, something in the domain of forwards, but something specific. Can you think of the name?
So could you give us something more to work on? Then maybe we can guess it.
Uh, Actually, I don't think there are enough hints now. But fine, I'll tell you the answer. It's FRA, or forward rate agreement. So were you guys introduced to FRAs in the past as a part of your derivatives or any other class? So FRA stands for a forward rate agreement.
Sir, it's basically deciding at what rate you'll be lending in the future, right?
Correct. Lending or borrowing, whichever. Yes.
Yeah. So, sir, I think this particular terminology wasn't used, but the concept we've
Okay.
discussed, I think so.
Okay. Okay. And did you guys work on pricing of FRAs also? FRAs maybe at
No, no, sir, we
initiation,
did
which.
not.
Okay. Okay. So that is something which you can do later on. Yeah. So just a related product. So swaps is definitely one, but swaps is maybe a step ahead. FRA is before that because FRA is just one single shot cash flow, whereas swap is more of a series of cash flows. So it makes things slightly, I won't say complex, but maybe something more than a FRA. But yes, a swap is definitely an application. So again, I have, so I can represent this in the form of a simple equation. So let's say S1 is my 1 year spot rate. S2 is my 2 year spot rate. And F11 is the forward rate which I'm interested in, which is my unknown. So I can write an equation, a simple equation. So I have 1 plus S2 square equal to 1 plus S1 into 1 plus F11. So let's say I call this left hand side as portfolio A and right hand side as portfolio B. So that way, if I'm an investor and if I have a 2 year time horizon in mind, then I, as an investor, if I have to invest certain X amount of money today, then I should not be, or maybe I should be indifferent about whether I'm investing my money at S2 for a period of 2 years, or I'm investing my money at S1 for a period of 1 year, and then reinvesting my proceeds at F11 for the next 1 year. So that's how I would like to interpret this. And that's why we have this kind of a equivalence. So finally, if I start with a certain amount of money today in both portfolio A and portfolio B, and no matter what approach I follow, I should arrive at the same corpus at maturity, which is my 2 year time point. And this is how spot rates tie up with forward rates. So is this okay? Okay. So again, a simple equation which you can relate these two important ideas, spot and forward. So let me just see what's the next point on the discussion. Also, I mean, this is at times also called as an implied forward rate. So they mean the same thing. Why implied? Because this is something which you have to imply from the going rates, isn't it? Because you have S2, you have S1. So when I say have S2 and S1, imagine your bootstrapping engine is ready and you have S2 and S1 with you. But F11, this is something which is not readily available. Now, this is something which you have to imply from S2 and S1. So many authors prefer to call this as an implied forward rate rather than just a forward rate. But any terminology which you use, it will mean the same thing, forward or implied forward. Okay. Yes. So yes, I mean, your example of usage of this in swaps is correct. So any specific portion of the interest rate swap whereby you feel that forward rates are required? Anyone? So where exactly would you like to use this in a swap pricer? The swaps is the correct example, but where can I use it?
So the entire concept of swaps is actually based on forecasting interest rates, right? So anytime you use a swap, you are practically forecasting your forward rate and you're trying to assume your cash flows, right?
Correct. So out of two legs of your swap, so imagine a plain vanilla IRS. So in
Yeah.
which leg would this forward rate thing impact? A fixed leg or the floating leg?
So the floating leg, because I would be looking for, like if I'm looking at receiving the fixed rate, I would like to make more money, right? So I would apply it on the forward rate that way.
Uh,
The
so
floating
yes,
leg,
I
sorry.
mean, so don't worry from profitability perspective, but from a logical perspective, you're right. It has to be applied on a floating leg because the thing is, we are interested in the floating coupons, right? And for the fixed leg, we anyways have a coupon. So let's say if I have a plain vanilla IRS, let's switch color because red is something which is not very pleasant to the eyes. Okay, so for an IRS, I have a fixed leg and I have a floating leg. Imagine it's a 1 year plain vanilla IRS, and let's say we have quarterly payments which are happening. So I have Q1, Q2, Q3, and Q4. Now let's say at the time of initiation of this swap contract, I arrive at a fixed coupon of C%. So can you think of an approach as to how this C% was derived? So was this covered as a part of your other subjects? And how do you calculate the fixed rate on a swap?
Awesome.
So it was covered, but I don't think we remember. At least I don't.
Okay, okay. So this is something which you call as now this rate is derived based on what the interest rate term structure is on that day. So imagine that I have a LIBOR IRS or I have a let's say it's simple USD LIBOR IRS. Then I will look at what is the LIBOR curve standing today, standing now, and based on that, I'll try to estimate this value of C%. So again, this is something which we'll try and see if we can cover in one of the subsequent sessions if we do get time. So, so that time we'll see how exactly a fixed rate on a swap gets computed as well. For now, imagine that methodology is there and we have C% with us directly. So for the fixed leg, I have, so in case I have to look at my cash flows, not that, no, let's not worry about discounting these cash flows. That is something which is just a natural progression of this, simply applying a discount factor. So my cash flows here are dependent on this C%, which is fixed. So I'm going to imagine this is my fixed rate. Now, for a fixed rate, there's no problem, isn't it? Because when I know that some rate is fixed, that basically implies that it's not going to change throughout the life of the swap. It will remain as it is. But for a floating leg, I can't really say so. So if I have to look from a floating perspective and if I have to see what are my cash flows, that is, if I want to know what are the respective coupons. So when I say coupons, respective floating rates at respective time points, I need some methodology to do that. So let's say I'm entering into the swap today. I may be having access to the first fixing. So maybe if I call this as maybe L1, L2, L3, and L4. So L1 is something which will be available to me. So this can be like my first fixing. So when I say first fixing, if I am entering into the swap today on 16th of March, I can have my T minus 2 fixing which is available. So maybe T minus 2 days back, that is 14th of March, I have my LIBOR rate. I can simply look that up and that can become my first fixing. But L2, L3, and L4, this is something which is unknown. Now, why I say this is unknown? Because these are floating, right? Now, these are going to keep on changing every day because every day I have a new LIBOR curve. I have new L2, L3, and L4 which is going to come in. L1 will not change because that has been frozen. That first fixing is there. But to figure out L2, L3, and L4, I need to be familiar with the idea of forward rates. Because without forward rates, I will not be able to figure these things out. And if I'm not able to figure out L2, L3, and L4, that means I don't know what the floating rates are for Q2, Q3, and Q4. And if I don't know what the floating rates are, I cannot calculate the present value for this leg, because finally we know that we need to calculate a PV of fixed leg and a PV of floating leg and simply take the difference, which will give me the MTM for the swap. Now, in order to calculate this MTM, this PV of floating leg needs to be done. And for determining the PV, as a first step, I need to know what is the cash flow which is to be discounted. And that cash flow is something which will be given by L2, L3, and L4, which are floating rates. And that is something which has to be derived using the forward rates logic. So without the idea of forward rates, you cannot price a swap. Does that sound okay? So is this something in line with what you have studied in the past? Or is this entirely new?
So this is a little different, sir.
Okay, okay. All right, but maybe the approach might be different to what you have discussed in the past, but the conclusion should be the same, because finally, I mean, it doesn't matter what approach you follow, but the way you end up, you
Yes,
should end
sir.
up with the
Yes, sir.
same L2 through to L4. Okay. So any questions on this approach? Okay. So later on, we'll spend some time understanding FRAs or forward rate agreements, because that is like a step ahead once you know what are spot and forward rates. So once we discuss FRAs, you'll have a better understanding of how do you handle a forward rate agreement. And once you're comfortable with FRAs, that makes your swap pricing also easy, because you can imagine that after making the slight adjustments to your FRA pricer, you may want to extend that to a IRS. Of course, now IRS is a different beast altogether, but the understanding which you develop for a forward rate agreement is something which will help you for swaps as well. So maybe we can discuss FRAs as a part of our discussion in one of our subsequent sessions. Also, again, another example of this can be a floating rate bond. So basically, I would say any floating rate product which you're handling, you'll require the idea of floating rates or idea of forward rates. So any floating rate product, I would say. So you could have a floating coupon bond, you could have a FRA, you could have a IRS, you could have a cross currency swap, or you could have any other structured variety which has a floating leg associated. So the moment you have a floating leg which comes in, you have to refer to forward rates. Just using the normal spot rate or normal yield curve is not good enough anymore. So that way, spot rates and forward rates is something which you'll end up using very, very often. So I would say spend some time later on as well to further deep dive into these things. When we discuss FRAs, you'll have some additional insights on this. So request you to hold on till then. I'll just go back. Idea of spot rates is done. Using of spot rates for bond pricing is done. Bootstrapping is done. Implied forwards are done. Why do we require implied forwards are done as well? All right. So good. So we have covered things on spot and implied forwards. Now we'll go on to a few risk measures which we use in bond pricing. So maybe before we go there, it's close to 10:15. So should we take a break for like 10 minutes and be back? And let's say we start by 10:25 or something.
Yes, sir. That works.
Yeah. Okay. Okay. So a 10-minute tea break and we can restart. Hi guys, can we restart? Is everyone back?
Yes, sir.
Okay. Okay. Now we'll start with a couple of risk measures which you require for bonds. One is duration and next is convexity. So duration is a measure of interest rate risk for a bond, or it's a measure of interest rate sensitivity. Now, why this is important? Because for any bond, interest rate is something which plays a very important role in determining how much is or how much is the risk of a certain bond. So maybe as the interest rates fluctuate or as the spreads change, we have an impact on the bond price. So that way, the portfolio valuation and the related profit and loss also gets impacted. So that's why duration becomes a very handy and a useful calculator, which is used by traders and risk managers in order to estimate what is the interest rate sensitivity of their bond portfolio. And I would say that interest rate is the largest risk which is carried by any banking or a lending institution because of the nature of their business. So be it loans or be it deposits which they accept from people like you and me. So we may be depositors and they may be lending it to some businesses. So finally, they are lending in some type of a bond or some type of fixed income instrument, isn't it? Because whenever I'm parking, let's say a time deposit or what I call the fixed deposit with the bank, and let's say the bank is using that money in order to lend it to businesses or entrepreneurs. That is also similar to a fixed income lending which they do, because even the loans which are advanced to anyone, that borrower has to repay periodic interest and principal coupons. So I would say that it's very much like a fixed income business. I would say borrowing money as well as lending money. And since the entire business is based on fixed income like logic, interest rate becomes a very important component for their risk. So that's why interest rate analysis is important, and duration is a convenient measure to do that. So there are different types of duration measures. So we have a Macaulay duration, we have a modified duration, and we have an effective duration. So these are three popular measures which you use. And all of these essentially tell you how sensitive your portfolio is to the changes or movements in interest rates. So that's what a duration metric will try to explain, be it anyone. And I also tell you how exactly we can use this elsewhere. So things like capital charge, etc., also require an idea of duration. So we'll talk about that when we talk a bit about bank capital, etc. So something in one of our subsequent sessions. But generally, giving you a simple example of how to calculate a duration. So we'll see Macaulay duration, because modified duration is just a small enhancement over Macaulay. So we'll see you working for this. I'll tell you an extension, how you can extend that to Macaulay to modified duration. And then I'll graphically show you how exactly effective duration can be calculated as well. So Macaulay duration can be seen in two ways. One is the interest rate sensitivity. So you can call that as a measure of sensitivity to the underlying rates. Whereas second, other way to put this is to basically have an idea that how much would be the time for an investor to receive their entire investment back from a interest rate product. So when I say entire investment, that means the discounted values of their coupons and the final face value. And finally, when I say I'm discounting the coupons and face value to estimate what is the time for me to receive my investment back from a bond, I am having an interest rate sensitivity, because my discount factors are going to be impacted by changes in interest rates. And whenever that happens, that will have an impact on the time for me to receive my investment back. So I think someone has raised their hand, is it? Yeah, Neil, please go ahead.
Yes, so if I may, duration can also be seen as that one particular time when, if all the nominal amount of funds is transferred at a very single particular time, then it equals to all the cash flows at different points. So that helps us understand if it is very late or if it's very early. It helps us understand if the interest rate will impact us severely or mildly.
Okay. So are you looking at a yield change, or are you looking at maybe interest rate fluctuation at a specific yield point by holding everything else constant?
Yes, sir.
Correct.
Yeah,
Right. So
you
that's a
pick a
related.
very specific time for it.
Correct. So that is a related concept. So that is something which we call as key rate duration. So we'll talk about that in a moment. Yeah.
All
So
right, sir.
so allow me to just uh, share a small working on a Macaulay duration. Let me just open a small Excel on this share screen. So again, I have taken a simple bond, a plain vanilla bond. The face value is 100, maturity is 3 years, coupon rate is 10%, frequency is taken as semi-annual, and the yield is assumed to be 12%. Now, we intend to calculate what is the duration for this particular bond. So a simple calculation, which we show via a tabular form here. So we have various time steps. So starting from 6 months up till 3 years with a gap of 6 months each because we have a semi-annual bond. Then we have the cash flows, which is 5 units each because I have a coupon of 10%. So that's 5 units semi-annually. So 5 units each and final face value of 105. Face value plus the coupon, which is my final cash flow. Next, I calculate my discount factor, which is nothing but e raised to minus RT, simply looking at the yield. So I'm using the YTM number here for my computations. So e raised to minus RT is just plain discount factors. Then I calculate PVs of my cash flows. That is, I take my individual coupons or any cash flow for that matter, whether it be coupon or whether it be my final cash flow, which is coupon plus the face value, I apply a discounting. And accordingly, I calculate the PV or present value of these respective cash flows. That is standing today, how much are these cash flows worth? That is something which my PV tells me. So my bond price comes out to be 94.21 using this. Now, next column is I want to know the weights of each of these cash flows vis-a-vis the total bond price. That is, I want to know what is the contribution of each of these cash flows towards my total bond MTM. So I simply take the ratio, that is, I take my individual cash flow divided by the total MTM, and I repeat that for every single step. Naturally, I should sum up to 1 because it's just like a weighted average number. So overall, my ratio or the addition of weights have to sum up to 1, which exactly what happens here. Next, I call calculated time weighted number. So I have my time steps and I have the weights which I have calculated. So again, a simple multiplication. You don't need to note this down. I'll email you this Excel later on, so you can go through this subsequently as well. Just focus on the approach right now. And finally, I add up my time weighted things which I calculate. So time into the weight column which I calculate, I simply sum them up, which gives me 2.65. So 2.65 is what I call as the Macaulay duration for this particular bond. Now, as the yields change, this duration is also going to change. So that's why we say this is a measure of interest rate sensitivity, because as interest rates move, I will have an impact on my overall result. And that is why we call this as a measure of interest rate risk or interest rate sensitivity. So now my question will be, if my if my coupon is 0%, how much should be my duration?
So it will be infinity basically.
Okay. Anyone else? If I make this 0, what would happen? So how much should be my sell in green?
So it will be equal to the maturity of the bond.
Absolutely. Very good. Because for a zero coupon bond, we don't have anything which gets paid out initially. We just have the final cash flow which happens at maturity. So that's why my duration will be exactly be equal to my time to maturity. So that's why we say that zero coupon bonds are comparatively riskier as compared to a coupon paying bond, because for a coupon paying bond, I am periodically receiving a certain coupon back, isn't it? So if I'm purchasing a bond, some of my investment is coming back through the form of coupons. So in the end, I don't have to Of course, my final face value is there, but my entire interest accrual is something which I don't have to wait till maturity, isn't it? Because I receive periodic coupons along the way, and at maturity, I receive my face value. But for a ZCB, that isn't the case, because for a ZCB, I need to wait right until the end. So my entire investment is exposed to interest rate risk because I don't have anything in hand right now, isn't it? If I invest in a ZCB, I wait right until 3 years until I get anything back. So that way, from an interest rate sensitivity perspective, a zero coupon bond is comparatively riskier as compared to a coupon bearing bond or a coupon paying bond.
Yes, sir, got it.
Yeah. Next is modified duration. It is very, very similar to this. Only thing is here I have applied continuous discounting. If I just adjust this for a different compounding frequency, or if I use discrete discounting, it becomes a measure of of modified duration. So I don't have a calculation for that, but it's very, very similar to Macaulay. So the answer will also be very, very close by. I'll tell you one more measure which also gets used, which we call as an effective duration. So something which I can show via a whiteboard. So allow me to switch to my whiteboard. So something which you can use for bonds with optionalities as well. Now, generally, whenever you have bonds with optionalities, that is either a loan or maybe any kind of a bond with a call or put provision. That is where uh, these cash flows can get disturbed because if a issuer decides to exercise the issuer call option or if the investor decides to exercise the investor put option, then that has an impact on the overall cash flow result. And accordingly, I need to make adjustments in my duration measure. So that is where an idea called as effective duration can be used. So giving you an idea of how to calculate an effective duration. So this is my price versus yield chart. And this is my relation. Let's say I'm standing on this point right now. Let's say I'm standing on point X. Then what I do is I make a small movement. That is, let's say I'm here. I'm just exaggerating the movement a bit so that it becomes easy to view optically. So let me just name these points on the coordinate axis. So let's say I would call this as maybe P minus. I will call this as P plus. Let's say I call this as Y minus and Y plus. And let's say
Sir,
this is Y. Yes.
sir, are you doing something on the whiteboard because we are
Yes.
not able to
Yes.
see anything?
Oh, okay, okay. I thought I shared the whiteboard. Sorry. I just tried to switch one second. Is my whiteboard visible now? Sorry, can't share your screen. Why an error has occurred? So is my whiteboard visible?
No, sir, nothing yet.
Give me a small prompt saying that something wrong with screen sharing. Okay, it's not allowing me to share. So guys, allow me this. I'll just exit the meeting and I'll rejoin in a second because that screen sharing option has got disabled. So I think I need to exit and come back. So just allow me a minute. I'll be back. Yeah, now it's allowing me to screen share. So now is the whiteboard visible?
Yes, sir.
Okay, good. So I'm standing, let's say, on point X, and for point X, let's say I have a certain price P and a certain yield Y. So let's say this is my current point which I'm standing on. And I want to know or I want to measure the sensitivity of my bond to a small change in yield. So I'm making my yields to change by a small quantum. Let's say I change this by delta Y. Let's say these very, very small numbers are delta Y. That is standing on X, I reduce my yields by delta Y. I come to Y minus and on Y minus, I price my bond, I get it as P minus, which I've shown here. So this is my P minus, and this is the P plus. Similarly, I come back to X. Again, I increase my yields to Y plus, and I reprice the bond. I get a P plus. So that way, I am allowing my yields to, as a part of my calculation, I'm making small changes to the yields and seeing what is the impact on my overall bond portfolio. And based on this, I can have an estimation as to what is the impact of this yield change on the bond price. So if I recollect correctly, the formula for this is something like P minus P plus upon 2 into P into delta Y, something like this. So this becomes my measure of effective duration or duration as such. So the idea is what I do is I want to measure the sensitivity, right? So standing today, I will allow small changes in yields and then see how much it impacts my position. So that gives me an idea of the sensitivity of my
So
bond.
is that minus and plus in the subscript?
Yes, yes.
All right.
So sorry, I'll just maybe
Yeah,
rewrite that. So let me just rewrite these subscripts once again. I'll write it more clear now. So let's say this is P. Let's say this is P minus. Let's say this is P plus. Similarly, let's say this is my Y minus. Let's say Y minus, and this can be Y plus, and let's say this is Y. So that way, what a trader or a risk manager would do is if they make this kind of a quick change in yields and see what the impact is, they will have an idea of the sensitivity. So this is like a quick calculator which a trader can have ready. So because they anyways have a bond pricing engine with them. So what they can do is they can simply change the input yields. And by changing the yields, they can get to see what are the impact on the bond price. And using that impact on the bond price, they can estimate a duration. So via the change in MTM, which you see, that would give you an estimation of what could be the sensitivity of your bond. So this is another way of using a duration measure for measuring your interest rate sensitivity. Also, this is a popular technique whenever you have, let's say, a mortgage-backed securities portfolio, an MBS or an ABS portfolio, or maybe a bond with optionality, whereby your cash flows uh, can be occurring at some unpredictable way. Why unpredictable way? Because for a mortgage security, if the homeowner decides to make a prepayment, that has an impact on the future coupons or the future cash flows. Next is if I decide to use an issuer call option. If I'm a bond issuer, I may want to call back the bond, which is going to again disrupt the coupon payments because I'm calling back the entire issue. I'm going in for an early redemption. Second can be an investor selling the bond back to the issuer. Again, that can have an impact on the overall behavior of sensitivity. So all of these things can be captured through an effective duration measure as well. So whenever you're working with, especially bonds with optionalities, you would end up using effective duration. But otherwise, for plain vanilla bonds, your modified duration should be good enough, Macaulay or modified. Generally, modified duration is something which we prefer, but again, they are very, very closely linked to each other. Macaulay is more using continuous rates, whereas a modified duration is whereby we adjust it for a certain payment frequency, or we uh, look at the respective time points at which we receive coupons, which is generally semi-annually. So in most of the interest rate calculators which you will observe in banks, they end up using modified duration. So even as a part of your capital charge computations, you require duration as a metric, and that is also a place whereby modified duration gets used. So we'll talk a bit about capital charge in one of our subsequent sessions, but duration has an application there. Along with that, most traders will have a small calculator which will run on the side, which will help them estimate what the duration of a bond is, because every trader is interested in how exactly their bond portfolio is behaving vis-a-vis change in interest rates. Also, a risk manager might want to know what is the risk which a certain bond is contributing because of interest rate fluctuations. So because of all these reasons, you have a duration calculator. So for a trader, you'll have a trader's calculator which will run on the side. For a risk manager, maybe they could have something configured in the system which will give them a duration metric directly. And that is something which they can use in further analysis. Again, there is an idea which we call as limits monitoring as well. So when we talk a bit about exposure monitoring, we'll talk about limits framework. So as a part of limits monitoring procedure, duration metric gets used. So how exactly you do limits monitoring, that is something which we'll see in our subsequent sessions when we talk of exposure monitoring for either interbank or for any other client whom you may be transacting with. So I request you to hold on to that idea till then. But does this idea look fine? Any questions on this? Okay.
No question, sir.
Okay. So let me just see what's the next point. Yeah. Now, let's say I want to figure out this delta y. So let's say I want to configure a certain model and I want to figure out what should be the value for delta y. So let's say I have three choices in mind. So let's say I want delta y to be 1 basis. Let's say I want delta y to be, let's say 100 basis, or maybe I want delta y to be 200 basis. So out of these choices, if I are to decide what should be the value for delta y, what would you say? I mean, which value of delta y should I pick and use it in my calculation? So should it be 1, 2, or 3? What do you feel?
Sir, I think one will give us a very erratic answer. And when it comes to two, when it comes to option three, we usually don't see a 200 bips movement.
Okay, so maybe
So,
I'll drop this to let's say 150.
oh, okay. I mean, then, sir,
Or
the answer is subjective if we can keep on.
okay, any other views? Any other way of looking at this?
Sir, given the so sorry, Shivam, continue.
No, 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 go ahead. Actually, I was asking what was the question. I didn't understand.
Okay, so the question is, if I have to build a model around this, and I want to figure out what should be the value of delta y, and I have three choices. I have to choose between 1, 2, and 3. So which option should I go in for? So I'll give you an idea, or I'll give you a hint. So think from a curvature management point of view.
So, if I may.
Yes, please.
So, given the fact, I was going to mention this, that given the fact that we have to model the curvature too, if we take very big movements, we will get like these broken linear modeling of it. So, you might as well just use a sensitive one bips movement to
Correct.
accurately get the curve.
Very good. Yes. So that way, I mean, as you rightly said, I cannot go in for larger changes in yields. So I'll tell you the reason why. So anything like 100 basis or 150, that is something which will give you incorrect estimation. So the reason is there is a curvature in the inherent price versus yield chart. Now, because of the curvature, you need to figure out some way to handle that curvature as a part of your sensitivity. And duration is a first order derivative. So duration is given as dp by dy. So when I say a first order derivative, can I say that this is a linear measure? So would that be a correct way of
Yes,
putting
sir.
it? Yeah.
Yes, sir, because the
So
slope only gives us little information.
exactly. So this is just like a straight line measure, something like this. Now, whenever you have something which is linear in nature, naturally it understands anything which follows a pattern of a straight line. If you have any curvatures, this measure will not be able to understand it. Now, nothing wrong with the measure. It's simply a drawback or maybe a shortcoming of that measure, because the measure has been designed in such a way that it looks at the first order derivative only. So it doesn't have any flexibility as such. It will be dependent on a straight line. So now, coming back to our discussion, if I maybe redraw this figure once and show maybe a comparison of 1 basis versus let's say 100 basis. Let's say I'm standing on point X. Let's say this is my 1 basis, and let's say this is my 100 basis. Just drop these dotted lines here. So let's say this is 1 bits. So this is 100 pips. And maybe I can give points names also, maybe A and B. Okay, so now the two scenarios. The scenario in green is delta y of 1 basis point, and the scenario in red is delta y of 100 basis points. Now, if I see scenario 1, now although I've slightly shown these points apart because optically otherwise it will be difficult to see. Imagine that C and D are very, very close to X. So if I want to apply a duration as a metric, what I can see is I can draw a simple straight line which will pass through C.
Sir, I'm so sorry. Could you
Yes.
please repeat which is really close to what I'm so?
Yeah, so C and D is very, very close to X. So imagine,
All right, all right.
although I've shown this apart, but they are very, very close.
Yes, sir, got it. As compared to A and D, so
Yes,
we
yes.
can't. Yes.
Yeah. So slightly exaggerated distance, but imagine they are close. Now, if I draw a straight line, I have a straight line which will pass through C, X, and D. So this orange colored line, if I show all these points C, X, and D are lying on the same straight line. So when they're lying on the same straight line, can I say that I don't have to worry about the curvature bits? Because these are so small increments that I'm working on a very, very small small line segment, and that line segment is a straight line. So in that case, I don't have to worry about the curvature because in that small line segment, I have only a straight line portion which I'm working with. And that is why my duration here on this orange colored line will give me a decent enough approximation of sensitivity of price to the change in yield. Vis-a-vis, if I compare the points A and B, which are far apart. So if I intend to draw a straight line, it could be something like this. Imagine it's a straight line. My line is not very, so let me just try to redraw. Better I can stick to a dotted line. It's much easier to draw a dotted straight line rather than. Again, no significance behind drawing a dotted line. I'm just doing it for my convenience. And imagine this is also a straight line. Pardon my diagrams. Now, if you see, there is an error term which is being introduced. That is the curvature which is there. That is something which I am completely ignoring. So that is now this particular region, this shaded area which I'm seeing is something which my model doesn't understand. Now, it's not the fault of the model, but the model simply understands a straight line. So the model will not be able to comprehend these kind of curvature sections. That is these areas whereby there is curvature. This is something which my model simply doesn't understand. No fault of itself. Now, in this case, if I decide to use A and B as the increments, that is, if I decide on this delta y to be 100 basis points, the problem will be that I'll be introducing a significant amount of error term in my estimation. And because of the error term, my duration estimation will be incorrect. And it is because of this reason, I cannot choose delta y to be 100, but choosing a very, very small delta y, 1 basis point, is something which is preferable. So is that okay? Any questions? So these can be like your quick interview questions as well. I mean, they can quickly ask you, will duration be a linear measure? And if it is, then why it's a linear measure, etc. So maybe this can be one of the approaches which you can use to explain it to them. Maybe not on your current interviews, but maybe something later on. So we'll study one related concept which we call as PV01 or PVBP as we call it. So present value per basis point. So 01 represents the basis point and BP also is the 1 basis point which we are looking at. So again, another convenient metric which traders often use is PV01. So they try to estimate that given a certain duration and given a certain bond price, how much is the sensitivity of their bond position to that particular small change in yield. So again, a very, very small and simple calculation which I've done. Again, this is an approximation. So this saves a lot of time for the trader as well, because approximation at times are decent enough, because many times they are not really looking at the exact answer, but they're looking at something which is very, very close to the exact answer. So let's say I have a certain bond which is trading at 95. I'm just taken some bond price. Let's say the duration is 3 years. I think this has got linked to my earlier calculation. So it was 94.5. Fine. The price should not matter. If you like, we can just connect this. I have a bond price. I have a certain duration. I take a very, very small change in yield, which is 1 basis point, which is 0.0001. Now, if I were to estimate the change in bond price for this very, very small change in yield, I do a simple calculation. That is, I take my bond price, I multiply it by duration, and I multiply it by a small change in yield, and minus 1. Minus 1 is because price and yields follow an inverse relationship. So that's why we take a minus 1. And then I simply compare. That is, if I'm standing on the current bond price of 94.21, what would be the impact on the bond price if a yield change of 1 basis point is to materialize? And this is the result which I get, 94.19. So these kind of small adjustments are something which a trader will find immensely useful. So again, this is an approximation. Tomorrow, if a trader decides to actually price the bond, the answer will be slightly different, but it will be very, very close to what this number is. And from a trading perspective, you want a good estimation. You don't want the exact answer many a times. So at that time, if a trader has a fair idea that given a certain change in yield, this much is the impact on my portfolio, then this is how I can manage my other positions accordingly. So again, something like a quick calculator, which a trader will find immensely useful. So again, going back to our presentation. Discuss PV0. Okay, so before we give to key rate, let's discuss forward bucket PV0. So can you guess what would be the meaning of a forward bucket PV0, or maybe just a forward PV0? You can ignore bucket if you like. So what could be forward PV0?
Hello, sir.
Yes.
So just could you open the Excel and just change the interest rate by that 0.01 and see how much we actually get?
Yeah, we can do that. I need to change it here also. It will be a marginal change because, of course, you can play around this sheet later on, because I'm taking a very, very small change. So the impact is not going to be very large. But these small changes are also good enough, because right now we are taking just one bond. Imagine that I have 500 crores rupees invested in this bond. Then the impact will be far bigger. So think from that perspective. Think from an entire position-wide perspective rather than one single unit of a bond.
Yeah, I was just calculating if the new bond price and the price on the table would match up or not.
I don't think it will exactly match up, because, as I said, this is an approximation.
Approximation.
Yeah, so it won't tally exactly. They'll be very, very close by, which is decent enough for estimation purposes. So if one has to take a trading decision, this approximation is acceptable.
All right, sir. Thank you.
So any idea what a forward bucket PV01 may be, or maybe what a forward PV01 may be? Okay, so this has something to do with forward rates. Now, the PV0 is something which you do in the current yield curve or the current spot yield curve which is available. Now, a forward PV0 is something which you apply to your forward rates. So this is the same forward rates which we have discussed some time back. Now, forward rates are something which a trader or a risk manager is very, very interested in analyzing, because the movement in forward rates is going to impact a lot of things in your portfolio. So any floating rate debt or any IRS positions, any forward rate agreements, or any other interest rate sensitive product which has a floating interest rate as the benchmark. So in all of those products, your forward rate movements are something which are critical, because as your forward rates change, your overall position value also fluctuates. So any trader or a risk manager might want to know what is the sensitivity of these movements on their portfolio. And that is what you call as a forward PV01. Now, if you can have an estimation of forward PV01, you will know, let's say I'm managing a swaps portfolio, then I would have a decent idea that if my forward rates move by 1 basis points, this much is the impact on my IRS position. Because especially for products like IRS, etc., wherever you have a floating leg which you have to manage, forward PV0 is always a key. Now, simply doing PV0 may not be good enough. Now, possibly if it's a plain bond, if it's a plain vanilla bond and a fixed coupon bond, I think a normal PV01 is decent enough. But whenever you start working on floating rate products, which definitely are a part of a bank's portfolio, a forward PV01 is an additional number which has to be used in the calculation. So I would say as a part of your calculation, you'll have both things ready. So in most risk systems, you'll have a PV01 and forward PV01, both which are available for consumption. And that is something which a trader as well as a risk manager frequently track. So any questions up till now? Okay. Now, one concept, key rate duration. So one of you had spoken about key rate duration in some time back. So while we were talking of duration, so so now would you like to maybe elaborate more on this? So either I think Neil had mentioned either Neil or anyone. So what could be a key rate duration? So it's a measure of interest rate sensitivity, yes. But so I'll give you an idea. Think from a fixed income fund manager's position. So imagine that you are managing a fixed income portfolio, or you're a fixed income mutual fund manager, and you want to use this key rate duration to your advantage or for as a part of your analysis. So how exactly would you want to use it? Any guesses? Okay. So the thing is, whenever we are talking from a fixed income fund management perspective, so when you take a fixed income mutual fund manager, that means the manager will have a host of fixed income products or bonds as a part of their portfolio. So as a part of the bond prospectus, you'll have an idea of what type of bonds that fund is invested in. So whether they're investing only in GSEC or whether they're investing in corporate debt as well. So that composition also is something which you'll get to see when you look at the bond prospectus. So from a bond manager's perspective, interest rate sensitivity happens to be one key metric which is used. Now again, key rate duration is something which is not very popular amongst banks. They don't really do much of key rate duration calculations, but for fund managers, definitely, because every fund manager has a certain view on interest rates. That should be the case, isn't it? Because fund managers are supposed to be experts in their respective asset classes which they're managing. And if you have a bond fund which you're managing, you naturally need to have expertise around analysis of interest rates, and you need to have some view as to what you expect the rates to behave going ahead. So key rate duration basically helps a fund manager make an assessment that if they have a certain view on a rate for a certain tenor, and if that changes to, or if that is to materialize, then what will be the impact on their position? So imagine that you're a fund manager and all of your investments are within 5 years. So let's say this is your maximum investment tenor, and let's say these are your anchor points. So you have various investments with various time maturities. Let's say 1 year, 2 years, and 4 years. So let's say these are my anchor points, and I don't have any investments beyond 5 years. Imagine I work generally in the medium term. I don't do anything of long-term investments. So I don't want to track any long-term bonds, but 5 years should be good enough. Let's say that's my longest tenor. Now, Me as a fund manager, let's say I have a very strong view on the 2-year rate. And I feel that in the near term, the 2-year rate is going to jump up by 20 bips. Let's say this is my estimation. And I feel that this is a significant enough move, and I have a lot of assets which are around the 2-year time point. So I would want to see the sensitivity of my assets. So there is an easy way to do that. So what I do is I look at my current yield curve, which is my, imagine this is the flat line, which is my current portfolio, my portfolio allocation along this 0 to 5 years. I look at my portfolio, I use the current yield, which is going. So I simply download the yield curve from FIMNA and I use it in my calculation. And I price my entire portfolio. I calculate the price as P0. So I'm using the same bond pricing calculation for every bond in my portfolio, and I get the total value for my portfolio, P0. Next, what I do is I hold all the other interest rates constant. That is 1 year, 4-year, and 5-year rates. I keep it as they are right now. I'm not changing them. But I make the 2-year rate jump up by 20 pips. That is, I make a sudden spike in the 2-year rates, and then I reprice my portfolio. That is, for such a spike in yields, I reprice the portfolio. Let's say I get a P1. Now, difference between P1 and P0. So P1 minus P0 will give me a measure of sensitivity of the portfolio to a sudden spike in yields. Now, this kind of a difference gives me an estimation that if my analysis is correct and if the yields indeed move up by 20 basis points or around 20 basis points, then this will be the impact on my portfolio or impact on my current portfolio. And this is why we call it as a key rate duration. Why key rate? Because we have a view on a specific rate and we are holding everything else constant. We are just making one rate spike and then we see what is the impact. So for me, this 2-year happens to be like a key rate which I'm trying to analyze. And that's why we call this as a key rate duration. So any questions on this? Okay. So now the thing is, it may not always be an interest rate rise which I may be worried about. It may so happen that I have a certain view that the 2-year yields are going to drop by 30 basis. So even in that case, the approach doesn't change. I price my bond standing today, P0, using the current yield curve. Then I drop my 2-year yields by 30 bips. I hold all other yields as they are. And I reprice the bond. Let's say I call the new price as P2. And the difference P0 minus P2, that is something which will give me what is the sensitivity or what is the impact of such a yield drop on my bond portfolio. And again, this is a metric which is immensely useful for fund managers. So you will find that fixed income fund managers will keep a track of these things and they'll keep on analyzing such things often. For banks, I honestly haven't seen them using key rate duration up till now. So even during my time with the bank or during time in consulting, whenever we did consult with banks, no one was actually using key rate duration as a metric. But for fund managers, yes, they do find these things immensely useful. Now, again, if I want to know the duration of my portfolio, so we discussed key rate duration. Now coming back to the discussion on duration. If I want to know what is the duration of the portfolio of multiple bonds, so let's say I have 2 bonds in my portfolio. So let's say I have D1 and D2 as the duration of bond 1 and bond 2. And let's say based on the market prices of these bonds, I have W1 and W2, which is nothing but the weight of these bonds in my portfolio. So let's say the bond prices are P1 and P2. So W1 can be something like P1 upon P1 plus P2. And W2 can be something like P2 upon P1 plus P2. So that will give me an idea of how much these bonds are contributing to my overall portfolio value of P. So if I can see P1 plus P2 is equal to P. Now, if I have to know the duration of this portfolio, that is DP, I can say this is W1 D1 plus W2 D2. Or if I have to generalize this, if I have 10 bonds, I can write it as a summation I equal to 1 to 10. Or maybe let me generalize this. I can keep it as 1 to N WI DI. and this will give me a weighted average duration of my portfolio. That is, it will give me a sense that if, let's say, there is a parallel shift in yields which is to happen, let's say a 1 basis point parallel shift in yields materialize, then how much do I stand to gain or lose? Now, why I'm specifically talking of 1 basis, because that is the most common metric which is used by industry participants. You can have a larger change in yield as well, but generally you don't expect a wide fluctuation in yield. So even in a business as usual scenario, the yields don't change too much. In very extreme scenarios, yes, maybe you may see a sudden yield spike, but those are like very rare events. In a normal business as usual or BAU scenario, as we call it, the yield changes are very, very small. So that's why we generally stick to 1 basis, which gives us a decent enough approximation. Now, duration of ZCB and coupon bearing, that we have already compared on Excel. We still have like 5 minutes, right? 10. So can we discuss convexity, or are you guys tired? Because we have discussed a few technical stuff today. So can we discuss convexity now, or do you want me to cover it in the next class?
So next class, please.
Please.
Okay, no problem. Because that way, I mean, these are new concepts, so I don't want to overburden unnecessarily. So let me take the attendance quickly. So you guys have lectures after this also, is it?
Yes, sir.
Yes, sir.
Okay.
So the reference for what we have studied today is John Hull only.
John Hull is good, and I think any book on security analysis and portfolio management. Now, I would have ideally said Fabosi, because Fabosi is a good reference book, but Fabosi is a very large book. So that way, referring through Fabosi can be a challenge. But I would say anything pertaining to SAPM, security analysis and portfolio management, I think that should be a decent enough reference. And of course, Hull is there.
Okay, sir.
Okay, so starting with economics. So Akash Singh is present. Achal Jain.
Yes, sir. Present.
Akash Singh, yes, I marked you present already. Yeah, okay. Achal is present. Ayush is present. Adyasha. Tejas Akware.
Sir, Adhyasa
Present, sir.
present, sir. Present.
Sorry.
Sir, Adhyasa is also present.
Okay. Tejas Akware is present. Ali is present. Anjali Garg. Anmol Sen. Arismita Deka.
Present, sir.
Avni Mishra. Ayushi.
Yes, sir.
Okay, Sarvesh is present. Bhavya Dang.
Present.
Cherry Chhabra.
Present, sir.
Diksha Chauhan.
Present, sir. We are joining from the same laptop.
Okay. Dipanjan Singh.
Present, sir.
Okay. Gaurav Kadam.
Present, sir.
Gaurav Datir. Himanshi Verma is present. Jaideep Sen is present. K. Ayushi.
Present, sir.
Riya Shukla.
Present, sir.
Okay. Kriti Marwa is present. Mansi Singhal.
Present, sir.
Mansimran Arora.
Present, sir.
Manvi Kukreja is present. Mihir is present. Muskan.
Present, sir.
Okay. Namrata Gaur is present. Neil Dhar is present. Nikhil Agarwal.
Present, sir.
Prasoon Sharma. Pratik Maheshwari.
Present, sir.
Rachit Tyagi. Rahul Ghosh. Rahul Giri. Rahul Goswami. Rajat is present. Ashi Jain is present. Rishabh Kothari.
Present, sir.
Uma Keshri is present. Sahaj Manosha. Samiksha Chopra. Charanya is present. Shubham Jain. Shubham Jain is present as well, right? Okay, yes.
Yes.
Okay, and Shubham Kumar is also present, if I recollect. Okay, Shubham Kumar is not there. Someshwar Varma. Stuti Mehrotra. Anika Thakur is present. Vinaya Pawar.
Present, sir.
Okay. All right. So economics is done. If you guys have a session after this, you guys can leave. I'll quickly take the attendance for IB. Ayush Sharma is present. Alisha Gupta. Vidhi is absent. Anand Jain is not there. Anish is not there. Anjali Sethi. Arshada Imam. Barka Israni. Bhavya Patel. Saloni Bhujbal. Maitra Tirodkar. Devam Pandey.
Present, sir.
Okay. Diksha Kalra. Gauraja is present. Gayatri Narkede. Govind Mittal Sawan is present. Himanshi Virman is present. Hindu is absent. Ishita Saxena is absent. Kanika Goyal is absent. Karthik Mitra is absent. Kasro is absent. Lakshay Singhal.
Present, sir.
Mahi is absent. Mansi Gupta. Mathagi Barrier. Megha Parak. Nancy Alawat. Nancy Jain. Pratishtha Pradhan. Rohan Bagai. Rohit Poddar. Samiksha. Simran is present. Krishti Verma, Tanu Goyal, Tarang Kadyan, Gani Todkari, Twinkle Karnawat, Vaishnavi Shrotriya, Rajal. Vibhor. Vibhor is absent. Vidu Shirana is present. Yash Mehra. All right. Yeah. Thank you so much. Yes.
So Shubham from AP is also present, sir.
Shubham from, I think I have already marked you, Shubham.
So Shubham Kumar, sir, not Shubham Jan.
Okay. Yeah, there are two Shubhams. Shubham Kumar. Okay. Yeah. I'll mark you. Yeah, thank you. All right, great. So thank you so much. Thanks for joining in and have a good day ahead. And I look forward to meeting you on Saturday.
Happy Holi, sir.
Yeah, happy
Thank you,
Holi to
sir.
all of
Happy
you.
Holi, sir.
Thank you.
Happy Holi, sir.
Happy Holi.
Thank you.
Thank you, sir.
Bye-bye. Yeah, take care.